How do portfolio managers achieve sustained investment success? One common approach is a value investing strategy that is focused on the long term. This involves buying stocks that trade at a significant discount to their real value.
So markets or sectors that markets have discounted, perhaps because of near-term headwinds or perhaps other news that is unrelated to this. And we think that these markets could perform well in the next 3 to 5 years, then we would allocate more to these markets. Thinking long-term, thinking about the future, what will the world look like, what are the companies that are going to do well in that environment. I think thinking long-term should help investors gain better returns for their portfolios.
He cites one example of such long-term thinking that has produced superior returns.
When we first introduced semiconductors into our portfolio, it was part of the satellite allocation, so just a small amount. But eventually we realized that this semiconductors, this investment thesis is actually more structural than cyclical. And we do believe that as the world becomes increasingly tech-driven, demand for semiconductors will increase. So for instance, like you see cars nowadays, you have EVs, you have self-driving vehicles. All these cars, they contain lots and lots of electrical components. As the world becomes increasingly digitalized, we do expect demand for semiconductors to continue growing, which is why we think that this will benefit the semiconductor companies. Semiconductors is now actually a core allocation in our portfolios. I think returns have been quite favorable. I would say it is one of the top performing, or if not the top performing sector inside our portfolios thus far.
The core satellite approach consists of a stable core of long-term investments that achieve market average returns and a tactical satellite component that aims to capture above average returns.
The core portfolio would consist about 70 to 80% of the overall portfolio. So this would consist of broad-based, diversified investments that are meant to be the foundation of your portfolio. Then for the satellite portfolio, that is reserved typically for the higher risk investments, things like this is also where investors can express their views on certain sectors or markets that they are positive on. I think it's good to cap the satellite portfolio at perhaps maybe 10 to 20% of the overall portfolio, depending on your risk appetite, so as to ensure that your portfolio is not overly aggressive.
Other managers use a different approach to build a diversified portfolio.
I follow a 4-quadrant approach. Quadrant number 1 is the contrarian value investing. That's my own comfort zone. The second one is thematic investing, where there can be a very long-term theme, where perhaps valuations are expensive, but the earnings are coming through in a very sort of strong way. Quadrant number 3 is cyclical ideas. Essentially, something's happening in the world. Interest rates are going up. The dollar is weak. There's a regime shift. There's some ideas that can really work and have decent upside. And then the 4th quadrant is more about income investing, the stable defensive part of the portfolio, but always looking for dividend growers.
Whether professional or amateur, doing your homework on the companies you're investing in will help you manage downside risks. And that's particularly helpful when investments go sour.
If you know the company well enough, you know how much risk you want to take. And you can react better when the macro environment changes. It also tells you when to take losses, right? In a situation where it has gone wrong, in 2021, 2022, we had small exposure to the Chinese real estate sector for some of our fixed income fund. Now, initially, we thought that we are going into investment-grade bonds. And of course, on hindsight, that did not turn out well because the whole sector collapsed. The wrong assumption we had was that the sector was too big to fail, and the Chinese government will come in to do something. The government did come in to try to rescue, but as it turns out, the problem was too complicated for the government to solve. The other lesson that we learned was that we should have taken our losses much earlier than we did. But in retrospect, that also tells us that the risk management approach was actually a good one because we did restrict our exposure to the sector. right? And it turned out that we managed to limit our losses. So this is a good lesson learned, right? Both on the positive and negative side.
Learning from failures is crucial for long-term success.
There was a time, a couple of years back, where our portfolios were actually underweight the US. Valuations were quite high and we weren't comfortable with that. We thought that US equities probably might not have enough growth potential, which is why we have underweighted US inside our portfolios, and that is a decision that unfortunately did not turn out too well. But that being said, we have also readjusted our strategy. So instead of not buying the entire US market, we just don't buy certain sectors. So in other words, we try to be selective with our investments. So with the US, for instance, we favor sectors like the digital economy, where we think that the growth potential is a lot larger compared to the broader market.
One final tip from portfolio managers: pay attention to fundamentals and avoid distractions.
The important thing is reflect, and have patience. Returns are about psychology and fundamentals. Fundamentals don't move that much. The psychology moves a lot. When that psychology moves a lot and it moves against you, it can be a challenging period, but stick to your process, stick to your philosophy, be patient, because usually when the psychology sort of takes over in markets and things overshoot or undershoot, that's typically the time when one can make outsized returns.